The idea that a single political figure could sit behind closed doors and deliberately engineer a full-scale stock market collapse sounds compelling at first, especially in an environment where fear spreads faster than facts. It gives people a clear villain, a simple explanation, and a sense that chaos is actually controlled. But when you break down how financial markets truly function, that narrative starts to fall apart. Markets are not controlled by one person, one office, or even one country. They are massive, interconnected systems driven by millions of participants. Individual investors, hedge funds, pension funds, central banks, corporations, and algorithms, all reacting in real time to new information. What political leaders do have is influence, and that influence can be powerful. Through policy decisions, public statements, and economic direction, they can shift expectations. And expectations are everything in the stock market. Prices don't just reflect what is happening today. They reflect what investors believe will happen tomorrow, next quarter, and years down the line. If a leader introduces aggressive tariffs, signals a major tax overhaul, or escalates geopolitical tensions, investors start recalculating risk. They begin asking whether companies will earn less, whether supply chains will be disrupted, or whether economic growth will slow. When enough investors reach similar conclusions at the same time, they start selling, and that selling pressure drives prices down. This is where the confusion begins. People see a sequence of events, a political announcement followed by a market drop, and assume intent. It feels logical to connect those dots and conclude that the outcome was planned. But correlation does not equal control. A leader might push a policy believing it will strengthen the economy long term, even if it causes short-term volatility. Or they may underestimate how strongly markets will react. In many cases, the reaction itself is shaped not just by the policy, but by how it was communicated, how unexpected it was, and how it fits into the broader economic picture. Another layer to consider is that markets are forward-looking but also emotionally reactive. Fear and uncertainty can amplify movements far beyond what fundamentals alone would justify. If investors believe others are about to sell, they often sell first to avoid losses, creating a feedback loop. This can turn a modest decline into a sharp correction. No single individual needs to orchestrate that process. It emerges naturally from collective behavior. Algorithms and high-frequency trading systems can accelerate this even further, executing trades in milliseconds based on predefined signals, intensifying swings in both directions. There's also the reality that different groups within the market interpret the same information differently. While some investors might see a policy change as harmful, others might see opportunity. For example, a regulation that hurts one sector could benefit another. Money doesn't just leave the market, it often rotates. That's why even during broad downturns, certain industries or assets may perform well. This complexity makes it extremely difficult for any one person to predict, let alone control, the exact outcome of their actions on the market as a whole. It's important to recognize that political leaders operate within constraints. They face pressure from voters, businesses, international partners, and economic conditions that are already in motion. Decisions are often reactive as much as they are proactive. Even when a policy has a clear objective, the ripple effects can be unpredictable. Global markets are influenced by factors like interest rates, inflation data, currency movements, and events in other countries. A decision made in one nation can trigger reactions across the world, which then feed back into the original market in ways that are difficult to anticipate. The idea of a planned collapse also assumes a level of precision that doesn't exist in real-world economics. To intentionally crash the market in a controlled way, a leader would need to predict how every major participant will react, how global partners will respond, how central banks will adjust, and how quickly sentiment will shift. They would also need to manage the consequences: job losses, reduced consumer confidence, political backlash, which can be severe and long-lasting. The risks of attempting something like that would be enormous, and the likelihood of it spiraling beyond control would be high. What's more realistic is that political actions can act as catalysts. They can trigger movements that were already possible due to underlying conditions. If the market is overvalued, heavily leveraged, or sensitive to certain risks, it doesn't take much to start a downturn. In that sense, a policy announcement might be the spark, but the fuel was already there. Blaming the spark alone ignores the buildup that made the reaction so strong. Media narratives play a significant role in shaping how people interpret these events. Dramatic explanations tend to spread because they are easy to understand and emotionally engaging. Saying that a collapse was planned simplifies a complex system into a single cause. But that simplicity can be misleading. It can cause investors to focus on the wrong factors and make decisions based on fear rather than analysis. In reality, understanding markets requires accepting uncertainty and complexity, not reducing them to a single storyline. For individual investors, the distinction between influence and control is critical. If you believe that markets are being deliberately manipulated at will, it can lead to a sense of helplessness or panic. But if you understand that markets are driven by a combination of policy, data, sentiment, and global events, you can approach investing with a more grounded perspective. You start to see downturns not as mysterious or orchestrated disasters, but as part of a broader cycle that includes growth, correction, and recovery. This doesn't mean political decisions should be ignored. They matter, and they can have real impacts on industries, companies, and the economy. But they are one piece of a much larger puzzle. Smart investors pay attention to policy, but they also consider fundamentals, diversification, and long-term trends. They recognize that while headlines can move markets in the short term, underlying economic forces tend to play a bigger role over time. Ultimately, the belief that a single leader can fully control or plan a stock market collapse underestimates the complexity of the system and overestimates the power of any one individual. Markets are shaped by countless decisions made by participants around the world, each acting on their own information, incentives, and expectations. Political influence can guide the direction, but it cannot dictate every movement or outcome with precision. The moment fear enters the market, logic tends to leave. Prices start falling, headlines turn negative, and suddenly every decision feels urgent. People begin to believe that if they don't act immediately, they'll lose everything. This is exactly where most investors go wrong. Not because they lack intelligence, but because they're reacting to emotion instead of following a structured plan. Fear-driven narratives are powerful because they tap into a basic human instinct: the desire to avoid pain. And in financial markets, that pain is often tied to seeing your investments drop in value. When you see a red portfolio, it doesn't feel like a temporary fluctuation. It feels like a real loss, even if you haven't sold anything. This psychological effect pushes people to act quickly, often without fully thinking through the consequences. They sell assets to stop the bleeding, believing they can always buy back later at a lower price. But timing the market consistently is nearly impossible. By the time most people decide to sell, prices have already dropped significantly, and when they finally feel comfortable buying again, prices have usually recovered, meaning they've locked in losses and missed the rebound. Fear-driven narratives make this cycle even worse. When you hear phrases like "this is just the beginning," "the market is about to crash further," or "everything is collapsing," it reinforces the idea that selling is the safest move. These narratives spread quickly through social media, news outlets, and conversations, creating a sense of urgency and consensus. It starts to feel like everyone else is getting out, and staying invested makes you feel exposed. But markets don't reward consensus thinking in moments of panic. In fact, the biggest opportunities often appear when fear is at its peak. Disciplined investing takes the opposite approach. It requires you to have a plan before emotions take over. This plan is based on your goals, your time horizon, and your risk tolerance. It's not something you create in the middle of a market crash. It's something you build in advance and stick to when things get difficult. Discipline means continuing to invest regularly, even when prices are falling. It means resisting the urge to make sudden, drastic changes based on short-term movements. One of the key principles behind disciplined investing is understanding that volatility is normal. Markets don't move in a straight line. They go through cycles of growth and decline, sometimes sharply. These fluctuations are not signs that the system is broken, they are part of how it functions. Over time, markets have historically trended upward, but that upward movement includes periods of significant downturns. Investors who accept this reality are better prepared to handle it when it happens. Another important factor is diversification. When your investments are spread across different assets, sectors, or regions, you reduce the impact of any single downturn. This doesn't eliminate risk, but it helps manage it. During a market decline, some parts of your portfolio may perform worse than others, but the overall effect is less severe than if you were concentrated in one area. Diversification supports discipline by making it easier to stay invested during turbulent times. Long-term thinking is what ultimately separates successful investors from those who struggle. When your focus is on the next decade rather than the next week, short-term drops become less significant. A 10% or even 20% decline may feel dramatic in the moment, but in the context of a long-term strategy, it's just a temporary setback. This perspective reduces the emotional impact of market movements and makes it easier to stick to your plan. It's also worth understanding how quickly markets can recover. Some of the strongest gains often occur shortly after major declines. If you're out of the market during those periods, you miss a significant portion of the recovery. This is one of the biggest risks of panic selling. You're not just avoiding further losses, you're also removing yourself from potential gains. And because recoveries can happen unexpectedly, waiting for a clear signal to re-enter often means buying at higher prices. Fear-driven decisions are often influenced by short-term thinking and a lack of clarity about goals. If you don't know why you're investing, it's easy to get shaken when things go wrong. But if you have a clear objective, whether it's building wealth over time, saving for a specific goal, or creating financial security, you're more likely to stay focused. Your decisions become aligned with your plan rather than with the latest headline. There's also a behavioral aspect to consider. Humans tend to overreact to negative information and underreact to positive information. This bias makes downturns feel more significant than they actually are. It also leads to herd behavior, where people follow the actions of others rather than making independent decisions. In markets, this can amplify both declines and recoveries. Recognizing these patterns can help you avoid falling into the same traps. Discipline doesn't mean ignoring the market completely. It means responding thoughtfully rather than reactively. It means reviewing your strategy, ensuring it still aligns with your goals, and making adjustments only when necessary, not because of fear. Sometimes that might involve rebalancing your portfolio, taking advantage of lower prices, or reinforcing your investment approach. But these actions are deliberate, not emotional. Another overlooked aspect is the role of consistency. Investing regularly, regardless of market conditions, helps smooth out the impact of volatility. When prices are high, your contributions buy fewer shares. When prices are low, they buy more. Over time, this approach averages out your cost and reduces the pressure to time the market. It turns volatility into an advantage rather than a threat. Ultimately, the difference between fear-driven investing and disciplined investing comes down to control. Fear puts the market in control of your decisions. Discipline puts you in control. It allows you to operate with a clear framework even when uncertainty is high. It transforms market downturns from moments of panic into moments of opportunity, where patience and consistency have the potential to pay off over time.